On November 15th, Target Corp, the Minneapolis-based retailer, reported its third quarter earnings for 2023. While revenue on a year-over-year basis was lower, the market added 20% to the company's share price, boosting market cap by over $9 billion. Please note we're using GAAP accounting for our valuations. Target's revenue came in at $25.4 billion, down 4.2% year over year. Generally not good news for a stock to gain 20%, but it was in the other lines of the income statement where Target shined. Gross margin was 28.5%, up 10% year over year. Operating income was better by 29% at $1.3 billion, just over 5% of revenue. Pre-tax income came in at $1.2 billion, improving 26% year over year, and net income at $971 million was up 36%, just shy of 4% of total revenue. Comparable sales were down 4.9%, with net transactions lower by 4.1% and average transaction value by 0.8%. In-store purchases were 83.2%, slightly better, and digital slightly lower to 16.8%. Target closed one store above 170,000 square feet, leaving them with 273. They added 20 new stores, however, in the mid-size range, but closed 4 stores in the sub-50,000 square foot range. Target's valuations largely improved year over year, so let's take a look. Shares outstanding increased negligibly. Earnings per share reported at $2.10, up 36%. We think the market liked that. Sales per share were down 4% to $54.90. Cash per share was up to $4.13, up 100% as the retailer added $1 billion to its balance sheet. Book value increased 13.5% to 27. The annualized PE was 15.5 compared to the S&P 500 at 24.91. PE growth was 0.43. The leverage ratios showed the debt ratio slightly worse at 0.26 as long-term debt increased faster than total assets. Debt to equity was 1.19, improving as equity grew faster than long-term debt. The interest coverage ratio improved to 12.31 as the interest expense was lower on higher operating income. Liquidity ratio showed the current ratio at 0.86, marginally improved. The quick ratio, which doesn't include inventory, improved to 0.09, principally due to the change in cash previously mentioned. The cash ratio was also improved to 0.09, again because of the addition of $1 billion to the balance sheet. Target has an equity multiplier of 4.49, with the firm relying more on debt than equity to finance operations. Return on assets of 6.9% annualized was bettered by 35%. Return on equity was 31% annualized, improving by 20%. Turning to cash flow, note that these are 9 months ended data. Operating cash flow was $5.3 billion, up from $552 million from the comparable period. Lowered inventory levels, accrued liabilities, and accounts payable helped operating activities. Investing outflows were $3.9 billion spent on property and equipment. Financing outflow was $1.7 billion, better by 44%, as there were no share repurchases made this quarter. Free cash flow was reported as $1.9 billion, up 100%. The company paid a dividend of $1.10 per share with a yield of 3.38%, growing at almost 2%. Target's enterprise value is $61 billion, which is 2.4 multiple with respect to revenue and 32 multiple with respect to free cash flow. Market capitalization to income is 62 times. Guidance provided in the press release was that fourth quarter the company expects sales in a wide range around mid-single digit decline and GAAP and adjusted EPS of 120 to 260.